Hey, welcome back. I'm David, the Retirement Gnome. Today we have the next in a series of videos on how to use Boldin, how to set it up. And today we're going to talk about accounts and assets. But first, I'd like you to meet my helper, Sophie. Hello. She likes to sit right on my keyboard and make funny things happen in the video. So if her tail pops up during the video, you'll know exactly what happened. So let's learn how to add accounts and assets into your Boldin plan. Over on the left-hand side, you'll see what we always have is our navigation menu. Come on down to Accounts and Assets. You click on that, and you'll see it's broken up into, unsurprisingly, two areas. The top section here is Accounts, and then this section here is Assets. You'll also notice a button at the top which says Manage Connections. You can do this kind of automatically, and I'll talk about that, although that's not what I do. So let's walk through adding your accounts and assets manually first. Okay. So we'll pop this down. We'll see we have in here already a savings account with $25,000 in it. Let's add another savings account. Maybe it's an HYSA account or something like that. So you click on Add Account, click the little buttons with a plus. You choose your account type. You got all kinds of accounts you can choose from. You can have a checking account, an investment account, a savings account. I tell you what, we already have a savings account there. Let's add a checking account. So we're going to add a checking account. After you tell it, we're just going to call this checking account. You can give it a current balance. Let's say my current balance is $2,000, and you can give it an interest rate. Well, you can, when you see for accounts, you come down here and you click on rate of return, you'll see recommendations that Boldin gives you. In this case, since you've told it it's a checking account, it's going to recommend 0% because we all know checking accounts, right? But if you want, you can input your own. You can add a custom number. You can click on this and add your own number. You can add optimistic and pessimistic rates. What we'll learn later when we run models is that you can run an optimistic model, a pessimistic model, or an average model. And if you like running your models like that, you can put those kind of numbers in this. You can say, hey, this is the best case scenario for my checking account interest rate, and my worst case for my checking account interest rate. For right now, though, let's go ahead and let's just go with the Boldin's default, or their recommendation, which is 0%. If you look under that, you'll see a rate inspector, and rate inspector will show up for all of your accounts, and it gives you some idea of that. It'll give you numbers based on what you've put in: an average, an optimistic, a pessimistic, and a standard deviation. If you like to do that, and if you want to learn more, you can click on how rates work, and it will pop up here on the side and tell you exactly what these numbers are going to mean for you. If you want, you can model a rate change in the future. For a checking account, that hardly seems necessary. And finally, you can say, exclude this account from your withdrawal strategies. If you don't want to, if you have an account that has money in it, you don't want it to be part of your withdrawal strategies. Let's say you're setting aside money to buy a house in 10 years, and you don't want the calculator to use that money for future income or future withdrawals or something like that. You can actually exclude that from your withdrawal strategies. So what we're going to do is we're going to just say, we're going to leave it with a default. We will not exclude it at this point since this is a checking account. Then you save it, and now we're showing two accounts. We have a checking account and we have a savings account. Since this is a retirement planning software, it's probably a good idea for us to enter in our retirement accounts. So let's add an account, and let's add a 401k. Now remember, we have two people in this plan. We have Lorena and we have Lloyd. So who does this 401k? Let's say that both are working, so we'll add a 401k for each person. So this is Lloyd's. We'll call this Lloyd's 401k from Let's say he worked at IBM for a period of time. This is an older 401k account. Let's say it has a balance in it of $150,000. Sounds good so far. Now we get to choose a rate of return. Again, this is going to look different because now we're talking about what are rates of return for a 401k plan. And this looks different than the checking account, right? You can choose from these predefined rates: conservative, moderate, moderately aggressive, and aggressive. Boldin does not know your asset allocation. It does not know your mix of stocks. It does not know how you're invested at all. You have to choose this number. So based on your knowledge of your own investments, you get to choose the rate. You can choose from these predefined ones, or you can come down here and as we did before, you can choose a custom rate or an optimistic and a pessimistic rate if you want to do a range. I'm going to say that he's had this, that Lloyd has had this invested at IBM for a while, and it's moderately aggressive at 8.8%, which means he's probably mostly equities. And for simplicity, we're not going to talk about modeling a rate change in the future. And we certainly do not want to exclude this from retirement withdrawal strategies. So we'll leave those the way they are, and we're going to save it. Now let's say that Lloyd also has an account, where a 401k, where he's currently working. So we're going to add a 401k for Lloyd. This is Lloyd's 401k at, let's say he's working at American Airlines now. And this currently has a balance of $90,000. And he has it invested moderately. I don't know why Lloyd has chosen to do this, but that's what Lloyd has chosen to do. If you click on Rate Inspector, you can see what moderate means. It means an average rate of 8.08%, an optimistic of 9.7, a pessimistic of 6.47, and a standard deviation of 14.05. If we change that to, let's say we change that to aggressive, we look at the Rate Inspector, the average rate is higher, but the standard deviation is also higher. If we go down here to conservative, the standard deviation drops, but so do the rates. So let's say he's going to choose just moderate. Okay, we're going to save that. Now, Lenora is also working, so we're going to add a 401k for Lenora. You're going to click on My Spouse, and you're going to say Lenora's 401k. And it currently has a balance of $250,000. And Lenora also has hers invested moderately. And let's also set up, a Roth, because we can come down here, we can set up a Roth, a Roth account. So you'll notice up here we have taxable accounts listed: checking, investment, and savings. So they could have an investment account like a brokerage account. You have all these tax deferred accounts that are possible IRAs and 403Bs and so forth. And then tax-free accounts, 529s, AHSAs, and so on. We're going to set up a Roth IRA for Lenora because she is a good investor and wants to not be taxed in the future. This is hers. This is Lenora's Roth account. And let's say she currently has a balance in it of $50,000. And it's invested aggressively because she doesn't plan to touch that money for a really long time. So we'll save that. Okay, so now we have gone through and we have created a set of accounts which can contain their money in a variety of ways. Remember, you could also add a 529, you could add multiple 401ks, multiple savings accounts, as many as you like to this. Now, not only do we have accounts where the money is held, but we also may have assets. So let's say that Lloyd, we're going to add a couple of cars. I already have entered into here Lloyd's Toyota Corolla valued at $25,000. Let's add a car for Lenora as well. This is going to be Lenora's vehicle. This is Lenora's Ford Bronco. I don't know why Lenora's driving a Ford Bronco. Let's say that it has a current value of $35,000. Now, this is an asset. We can choose, we can have it be an appreciating asset. A car is certainly not that. We can say that it's not going to change value, or we can call it a depreciating asset. Well, a car is certainly going to be depreciating. So let's pick depreciation minus 4%. And then we can look at the rate inspector and see what it tells us, how the model is going to handle it. It's going to average 4% with an optimistic of minus 4.8 and a pessimistic of minus 3.2. All right, let's save her account. And we can also add, let's say that they own, some kind of another asset. Let's say Lloyd's Rolex collection. Can I not spell collection? All right, Lloyd's Rolex collection. And let's say it has a value of $50,000 because Lloyd loves Rolexes and has been collecting them for a long time. And this is an appreciating asset. So we're going to add that as an appreciating asset. I promised I would talk briefly about the connections section. So let's do that. We'll go to the connections section. So again, accounts and assets. Up here we have manage connections. I'll click on that and show you. Now here it says you can manage financial institutions as well as associate your accounts with the manual entry from accounts and assets. So we've done the manual entry. If you want to connect this automatically to an existing account, you can do that. The way you do that is you click on Add Connection, you click over here on Financial Institution, and then you go through, they use, I believe they use Plaid. So let's say you have a Wells Fargo account, you might click on that, and then it will open up Plaid. Yeah, it uses Plaid where you go through an identification process to prove who you are. You end up adding your bank credentials to this, and then it will, after going through authentication, it will connect Boldin and your account. I'll go ahead and say that I'm not a fan of this, not because I don't trust Boldin and I don't trust Plaid, but I guess the real thing is I don't trust anybody. And so my recommendation to you is to do what I do, which is I do not connect my accounts automatically to my financial institutions. It's simple enough to go in on a monthly basis and update the amounts manually. It's really straightforward, and let me show you how you can make that easy. Now, if you explode the savings section here with all of your accounts, there's a nice little button here called Update Balances. And when you click on Update Balances, it brings all of your accounts right here. And all you have to do is just enter in your numbers one right after the other. It's super easy. And in my opinion, there's really no reason to connect to your accounts. There is risk associated with that. And you just may not want to do that. So there you have it. You've learned how to add accounts. You've learned how to add assets. I've shown you how to do the connections if you really want to do that, although I don't recommend that you do it. And in our next video, we're going to talk about housing, mortgages, properties, things like that. Thanks for watching. I'm the Retirement Gnome, and I'll talk to you next time.